Hi guys, welcome back to our channel. In the previous video we see the introduction and some history of the insurance, and in this video I am going to discuss about the principle of insurance working. Insurance involves pooling funds from many insured entities known as exposure to pay for the losses that only some insured may incur. The insured entity are therefore protected from risk for a free, with the free development being dependent upon the frequency and severity of the event occurring. In order to be an insurable risk, the risk insured against must meet certain characteristics. Insurance as a financial intermediary, a commercial enterprise, and a major part of the financial service industry, but individual entity can also self-insure through saving money from possible future loss. Insurability risk, which can be insured by private company, typically share seven common characteristics, some of which are followed. A large number of similar exposure units. Since insurance operate through pooling resources, the majority of the insurance policy cover individual member of large classes, allowing insurer to benefit from a law of large number in which predicted loss are similar to the actual loss. Exceptions include Lloyd of London, which is famous for ensuring the life or health of actors, sports figures, and other famous individuals. However, all exposure will have distinct differences which may lead to different premium tests. Definite loss. This type of loss takes place at a known time and a place for a known cause. This classic example involves the death of an insured person on a lifetime insurance policy. Fire, automobile accident, and worker injury may all easily meet this criterion. Other type of loss only be definite in theory. Occupational disease, for instance, may involve prolonged exposure to injurious condition where no specific time, place, or cause is identifiable. Ideally, the time, place, and cause of the loss should be clear enough that the reasonable person with sufficient information could objectively verify all three elements. Accidental loss. The event that constitutes the trigger of a claim should be fortuitous and at least outside the control of the beneficiary of the insurance. The loss should be pure because it results from an event for which there is only the opportunity for cost. Even that contains speculative elements such as ordinary business risk or even purchasing a lottery ticket are generally not considerable insurable. Large loss. The size of the loss must be meaningful from the perspective of insured. Insurance premium need to be cover both the expected cost of the loss plus the cost of the insuring and administrating the policy. Adjusting loss can supplying the capital needed to reasonably assure that the insurer will be able to pay claims. For small loss, the latter's cost may be several times the size of the expected cost of loss. There is hardly any point in paying such costs useless. The protection offered has real value to a buyer. Legal. When a company insures an individual entity, there are basic legal requirements and regulations. Several commonly cited legal principles of insurance. Number one, indemnity. The insurance company indemnify or compensate the insured in the case of the certain loss only up to the insured interest. Benefit insurance. As it is stated in the study book of the Chartered Insurance Institute, the insurance company does not have the right of recovery from the party who caused the injury and must compensate the insured regardless of the fact that insured had already sued the negligent party for the damage, for example, personal accident insurance. Insurable interest. The insured typical must directly suffer from the loss. Insurable interest must exist whether property insurance or insurance on a person is involved. The concept requires that the insured have the stake in the loss or damage of the life or property insured. What is stake is will be determined by the kind of insured involved and nature of the property ownership or relationship between the person. The requirement of the insurable interest is what distinguishes insurance from gambling.